Hey, what's up guys? My name is Caleb and welcome back to my channel. Now for those of you out there that are brand new to investing, the first rule that I can share with y'all is to never invest in something that you don't understand. But furthermore, I'm sure there's a lot of you out there who want to invest in stocks at some point, but don't understand what stocks are or how they work. So in today's video, I'm going to give you a complete crash course tutorial, so to speak, of how stocks work, how they function, all the different things stock related, and how that relates to companies. So without further ado, let's get things started here. Stonks. What are they? So I did something a little different. I made this really cool infographic that took all day, so I hope you guys really like it. Now, first things first, the definition. So a stock or a share is a security that represents a portion of ownership in a company or a corporation. You know, the company's net worth is basically just divided up into a bunch of like tokens, and then people can buy or trade and sell those things, and they represent a portion of the ownership. So when you own a stock, you own a part of the company. So assets is represented in this entire circle here. Picture this whole circle is the total company's assets. So this is like all their property, all their vehicles, all their inventory. The orange slice here, we got the liabilities. So this is like all the debts that they owe, just everything they're liable for is represented here as the 60 grand out of the total, which is 100 grand. And then we got the equity. This is basically the net worth portion of the company, and it's represented right here. This one's 40K, as you can see. This basically represents like what the company is worth after all is said and done. So, you know, once they, pay off all their debts, and you measure the remaining amount of assets left, if the company were to just sell everything all at the same time, the amount of money that you would have left is the equity. So the reason why I'm bringing this up is because this is where you get stock shares. If you were to divide it up like this into smaller slices, this is basically what shares of a stock are. You know, obviously there's going to be way more than 8 here, and yeah, that's kind of what a stock is. So it's just like little divisions of the net worth of a company. So there's two different kinds of stock here. We got the common stock and the preferred stock. And the biggest difference between these two is the common stock is the vast majority of the shares, and which you're going to hear about most of the time. The average person doesn't have access to the preferred shares. That's just kind of how it is unless you're like a millionaire. Now with common stock, you also have voting rights. So when you're electing like a board of directors for the company, if you're trying to make decisions, like corporate level decisions, if the company is trying to take itself in a different direction, the common stock shareholders have the opportunity to weigh in on these decisions. And with the preferred stock, there's typically no voting rights. Now they also have priority over dividend payouts, which I'll talk about later. And then they also have priority during liquidation. Liquidation is when they convert everything that represents the company back into cash again, and they are paid out to all the different shareholders. So the preferred stock shareholders get priority over both of these things. What happens when a company issues stock? So I'm sure you've heard of the New York Stock Exchange and the NASDAQ. So a way for companies to raise capital when they have like a business venture and just need like a bunch of money that a venture capitalist can't give them, and the bank can't give them, or any other like individual investor can't give them, they will do this thing called an IPO. So this is an initial public offering, is what it's technically called. And this is pretty much when a private company turns into a public company. You know, when it's a private company, there still could be shares of stock, but they're only accessible to like friends and family members and specifically designated people. But when you turn into a public company, now you're on the stock market, you're on the stock exchange, and any person can just go and buy and sell and trade shares of the company's stock. So this is also a great place for early private investors to cash out on their gains, because they cashed in like in the beginning. Say they gave the company like 100 grand to start, and now they're able to cash out at like 50 million because they rode the wave for 15 years until this company went public and got super big. And that's kind of how that works. So that's the initial public offering, the IPO. You'll probably hear these things a lot when you're getting into stock trading. So, but how many shares are there? So, real quickly before I get into this, if you could drop a fat like down below, that would be much appreciated. I hope you're finding value in this video so far. Now let's keep going on. How many shares of stock are there? So this is kind of a loaded question. Basically, there's a couple of different like kinds of stock when it comes to this question. There's the authorized shares, which is the total amount of shares that are authorized by the company to sell to the public, essentially. A lot of the company will actually keep a lot of these if they need to, but then they'll give out some of them, and these are called the outstanding shares. And this is basically the amount of shares that they have sold to other people, which will be restricted shares, which is basically people who invested early in the company, or maybe it's friends or family members, like I said earlier. And then you got the floating shares, which this is the amount of shares that are available to the general public through stock exchanges, through conventional means. How do we get the market cap, and what is that? So essentially, you know, that pie chart that I sliced up earlier, that would represent the outstanding shares. So this is the total of like the publicly available and the already owned by like the rich dudes shares of stock. Now you take that total number and you multiply that by the stock price. So right here I got 1337 as an example. That comes out to 6,600,000 ish. Where do we go from here? So there's three different like categories for market cap. There's the companies that are large cap. This is 10 billion and up. And then you got the mid cap, which is 2 to 10 billion. And then you got the small cap, which is 300 million to 2 billion. And you'll also find that within these, you know, caps or categories, I guess you could say, there's 11 different sectors here. I'm just going to show you guys real quick kind of what I'm talking about as far as like the float and the outstanding shares goes. So we're just going to type in Tesla. So right here is kind of where you'll see what I'm talking about. So notice like all these little numbers at the top where it says like open and previous close and market cap and stuff. Notice in the first column, you got the free float and the free float market cap at the bottom. So the free float is telling me that there's 802 million shares available to the public. And then right next to that in the next column, if you go one up, it says shares outstanding. And this says 990.02 million. So that's the total amount of shares that I was talking about earlier with the outstanding shares. The next thing that I wanted to mention was kind of stock exchanges, market makers, and share price and how that all works. So at the stock exchange, things used to be all done in person, whereas nowadays we got stuff like this app I just showed you. And then within those stock exchanges, there are market makers. Now these are basically guys who have like all of the float at like in their possession. And they basically, their job is to have a buy and a sell price, and they can never just hold on to the shares, and they're supposed to be like the middlemen. Now the buying price here would be called the bid, and then the selling price would be called the ask. So a market maker will usually make money by profiting the difference between these two numbers. So say that they want to sell a stock for, they want to buy a stock rather for $10, but then they're only willing to sell a stock for $10.05. So these little fluctuations throughout the day, even though that's only a 5-cent difference, you know, if you're trading those 850 million shares like I showed you earlier, that can obviously add up to a crazy amount of money. So I have this little infographic here as well. Notice something a little similar here. So this is a Bitcoin on the Coinbase Pro app, and you can see this is actually moving in real time right now. But that's basically what I tried to draw here. This is just a graph that represents the bid and the ask price, and the difference between the buy and the ask is called the spread, but I'll talk about that in a different video. Moving on, let's talk about some nuances with stocks. So first we got the stock split. So basically what this is when a company decides that they want to lower the price of their shares to make it more affordable for the average person like you and me. So for example, say that I have 10 shares here and they're $100 each. And then the company does a 4-to-1 stock split, which by the way, they can do 2-to-1, 3-to-1, 4-to-1. I'm pretty sure they can do almost any number within reason. And they can also do this the other direction, which would be called a reverse stock split. Now imagine they do the 4-to-1 stock split. Now I have 40 shares and I have $25 each. The total is still the same, but what's happening here is I can buy basically more shares with less money. Now let's talk about dilution here. So dilution is basically when a company offers stocks again after their IPO. Usually they'll do this because they need to just raise more money or something like that. There's a bunch of different reasons why they could do this. Bringing back that million share example that I got here. Now let's pretend that they do a second offering and they want to offer 250,000 more shares. So that 200 from earlier plus the 250,000, now we have the 450,000. So basically what's happening here is the float is increasing. So the amount of shares that traders can buy and sell is increased, but then it decreases percentage of ownership and your voting power in the company. Because basically your stock is like worth proportionately less because there is more of them, but your quantity is still the same unless you buy more, of course. Now then moving on here, we got the share buybacks. Now this is basically the exact opposite of this. So this is where a company decides that they want to kind of give their investors like more value for their buck. and so they want to buy some shares back, or say their float's just way too big or something. That company we had earlier with the 500,000 outstanding shares, let's pretend that they took 100,000 of that and they buy back those shares. So they take those back into their authorized shares. That was the white bar that I showed you. So now there's only 400 shares left, or 400,000. 300,000 are owned by the restricted still, but now in the float there is only 100,000. So as you can see, the float has gone down and the ownership per share has gone up, because now you own a higher percentage of that 100,000. Now here's the part that I was going to mention earlier about the dividends. So when a company makes profit, what's happening here? So the equity slice of the pie gets bigger, and there's more equity, there is more net worth. What does the company do then with this net worth? They can either pay out dividends to their investors, which is basically just dividing that profit among the shareholders via shares of stock or just straight cash, or they can retain those earnings and invest them back into the company so they can grow faster. Now, this is a really controversial thing in the kind of like investing world, I guess you could say. There is two types of people out there. There's people that want the passive income and insist on dividend portfolios. And then there's the people out there that want to see their companies grow like crazy and don't invest in dividends as much, or prioritize the non-dividend companies. It's really up to you. I always tell people to diversify and do your own due diligence on things like that. But those are the two options that you have there, and you can kind of see how they both can like have their pros and cons, because one, you get the money up front, but with a growing company, you get the money, in the future when they grow and have more profits and stuff like that. So it's kind of a trade-off there. So what happens when a company goes bankrupt, though? What happens to those shares? First thing I'm going to say right off the bat, I hate to burst your bubble, but the price of the shares is going to plummet like crazy, and it'll probably go down to almost nothing. So what's happening here during bankruptcy is basically, see on this pie chart how the liabilities slice has grown almost to the entire size of the pie. So as the liabilities like kind of keeps increasing and ends up being very close to like the total asset value of the company, where they're like breaking even, then a company can file for Chapter 7 or Chapter 11 bankruptcy. Now with Chapter 7, this is really bad. This is worst case scenario. This is where they turn everything they have back into cash. So their buildings, their cars, all their inventory, they have to sell and get rid of it. And that's why you have seen places in the past that go bankrupt or they sell out and they're like, clearance sale, everything 90% off. That's basically what they're trying to do, is they're trying to get as much money as they possibly can before they're legally required to like halt their services. If the company has a fighting chance, though, they can file for Chapter 11 bankruptcy. And this is basically where they restructure their debts. And there's a lot that goes into this, but in layman's terms, they're essentially like negotiating with their investors and the banks and stuff to see if they can get like better interest rate on their debt and things like that, to like lower the amount of debt they have or consolidate it a little bit so they can stay afloat. But when this happens, they can still fail and still have to liquidate everything. But during the process of restructuring the debt with Chapter 11 bankruptcy, you no longer receive bond interest payments, which I'll talk about in a different video, which is kind of like dividends, but just for bonds. And the dividends also stop. And the other thing I was going to add here is that when a company does actually liquidate, the people that are paid out first are the bondholders. And then after that is the preferred, like I showed you earlier. And then you got the common shares paid out last. So that's essentially everything you need to know about stocks. Like I said, they're just a representation of ownership in the company. And it's really cool once you get started getting into it. I really want to make a video in the future about like how to read those stock charts like I showed you earlier, because there's a lot of different crazy stuff going on those charts. And it's really interesting once you get to know it a little bit better. And then I also really wanted to make a video on the bonds, like I was saying, because bonds and stocks kind of go hand in hand. And I've talked a lot about this in previous videos, how stocks and bonds kind of impact the the volatility of your portfolios, and how like when you're younger, people usually have more stocks, and when you're older, people have more bonds. So I'm probably going to make videos on those soon. If you like this video, please drop a like down below. And if you want to see more content just like this, please consider hitting that subscribe button down below as well, with the little notification bell next to it. And yeah, with that being said, thank you so much for watching, and I'll catch you in the next one.